Washington, D.C., late 2010. The ink on the Dodd-Frank Act is barely dry. Inside a brightly lit Senate committee room, politicians are shaking hands. The air is thick with the scent of expensive coffee and self-congratulation. They believe they have just killed the beast that caused the 2008 financial crisis. Banks are being forced into straitjackets. Capital requirements are up. Risk is out. But they are not killing the risk. They are just evicting it. Imagine a massive, overflowing reservoir of water representing global debt. The government has just built a massive concrete dam around the traditional banks. The bankers inside the dam are safe, but the water still needs somewhere to flow. It begins spilling over the sides, carving new, unregulated rivers through the dark. This is the exact moment the shadow banking system, a parallel universe of credit, begins its explosive mutation. It will grow from $28 trillion to a staggering $63 trillion, eclipsing the very institutions the government fought so hard to protect. Welcome to the shadows. New York City, 2011. A corporate borrower sits across a sprawling oak table from a traditional bank lending officer. The borrower needs $500 million to buy a competitor. The banker shakes his head, sliding a thick compliance folder across the wood. "I cannot underwrite this," the banker says. "Basel III rules mean I have to hold too much capital against your debt. It destroys my return on equity." The borrower leans back, frustrated. "So where do I get the money?" The banker points to the window, out toward the boutique investment firms clustering in Midtown. "Go talk to the funds. They don't have our rules." This is the precise conversation that birthed the modern private credit boom. The borrower walks out of the regulated light and into a private equity firm's newly minted credit desk. The new lender smiles. "The bank said no because they are a bank," the fund manager says. "We are a fund. We will write the check today. But it will cost you." The deal gets done, but the regulator never sees it. This is the mechanism of regulatory arbitrage. Picture a visual balance sheet. On the left, a traditional bank takes your insured deposits and lends them out to corporations. If the loans go bad, the government steps in to protect your savings. Now, erase the word bank and replace it with non-bank financial intermediary. This entity does the exact same thing. It takes money from pension funds and insurers, and it lends that money to the exact same corporations. It conducts maturity, credit, and liquidity transformation. It creates credit out of thin air. But because it does not hold everyday retail deposits, it bypasses the grueling stress tests and capital requirements. If you want to understand how the global economy actually operates while everyone else is distracted by the stock market, you have to look where the real money flows. Hit the subscribe button and join the few who understand the true architecture of the financial system. We are tearing apart the blueprints of a parallel credit system that has grown to equal 78% of global GDP, entirely in the dark. By calling themselves funds instead of banks, these entities unlocked a gold rush. The Financial Stability Board defined them clearly as entities conducting bank-like activities without bank-like regulation or central bank safety nets. It was the perfect loophole. As traditional banks retreated from mid-market corporate lending, the shadow banks aggressively filled the void. They did not just replace the banks, they began to dominate them. The regulators in Washington and Basel thought they had contained the dynamite. Instead, they had simply handed it to a new group of people who were operating without adult supervision. The system felt incredibly efficient, generating massive yields for investors who were starved for returns in a zero-interest rate world. But a terrifying reality was beginning to form beneath the surface. These new shadow lenders were gobbling up the riskiest debt on the market. The loans the traditional banks were too terrified to touch. The safety net had been removed, and the tightrope was getting higher. The rise of the mega funds was about to begin, setting the stage for a $3 trillion experiment. London, 2015. The mahogany-panelled dining room of a private members club in Mayfair. The air smells of roasted lamb and expensive Bordeaux. The executives sitting here do not work for commercial banks. They work for alternative asset managers. They are celebrating a shift in the tectonic plates of global finance. As traditional lenders retreat under the heavy compliance costs of Basel III, these non-bank entities are stepping into the sunlight. The shadow banking system is no longer a fringe market of obscure securitization vehicles. It is becoming the primary engine of corporate finance. Imagine a vast, open frontier where the sheriff has been permanently reassigned to the neighbouring town. That is the corporate lending market in the mid-2010s. The rules of gravity have been suspended. The Financial Stability Board warns that these entities operate outside the regular banking system, conducting credit transformation without oversight. But nobody in this dining room cares about oversight. They care about yield. They are building a private credit machine that will soon bypass the public bond markets entirely, armed with trillions of dollars in dry powder. The private equity sponsor leans across the dining table, swirling his wine. I need $1.2 billion to buy out a healthcare logistics company, he says. The traditional syndicate banks are dragging their feet. They want too many covenants, and they say the leverage is too high for their internal risk models. The private credit manager does not blink. Forget the syndicate, he replies. We will underwrite the entire $1.2 billion ourselves. One single check. We can close in 3 weeks. We will give you the loose covenants you want, but you are going to pay us a 12% floating interest rate. The sponsor smirks and extends his hand. Deal. This dialogue is the engine of the private credit boom. Instead of a bank breaking a loan into 50 tiny pieces and selling them to different buyers over 3 months, a single shadow bank steps up and swallows the entire risk instantly. It is faster, it is bespoke, and it is incredibly lucrative. It is also entirely opaque to the regulators watching the banks. To understand why this is revolutionary, picture a massive infrastructure project. In the old world, a bank acts as a public toll road. Everyone can see the traffic, the government inspects the asphalt, and if a bridge collapses, the state emergency services rush in to fix it. Private credit is a private underground tunnel. It gets you to the exact same destination, but there are no cameras, no state inspections, and if the tunnel caves in, you are entirely on your own. This is the essence of regulatory arbitrage. A Federal Reserve working paper titled Less Bank Regulation, More Non-Bank Lending confirmed this exact phenomenon. Whenever the government tightened the screws on traditional banks, the credit did not disappear. It just squeezed through the cracks into the unregulated shadows. The non-bank entities began performing the core functions of a bank, taking funds from savers and lending them to borrowers, but legally structuring themselves as closed-end investment funds. By doing so, they stripped away the capital buffers designed to prevent another global meltdown. The speed of this migration caught the world completely off guard. By the late 2010s, the shadow banking sector was growing roughly twice as fast as the regulated banking sector. In advanced economies, this unregulated shadow began to equal a quarter of total financial system assets. The traditional bankers looked out of their skyscraper windows and realized they were no longer the masters of the universe. They had become heavily regulated utilities, while the private credit funds were the new apex predators. But there was a hidden danger in this aggressive expansion. The shadow banks were lending to the highly leveraged, sub-investment grade companies that the traditional banks had specifically deemed too dangerous to touch. The entire system was loading up on the most volatile corporate risk available, convincing themselves that their sophisticated models could predict any default. They were setting a trap for themselves. and the bait was the irresistible lure of double-digit returns. The golden age of shadow lending had arrived, but the foundation was built on a very dangerous assumption. Chicago, 2021. The skyline is obscured by a freezing winter fog. Inside a high-rise office, the chief investment officer of a massive state pension fund is staring at a Bloomberg terminal. The screen is a sea of red and flat lines. Global interest rates are at absolute zero. Sovereign bonds are yielding practically nothing. The paradox of this era is suffocating. The pension fund needs to generate a guaranteed 7% return every single year just to pay the retirement benefits of millions of teachers and firefighters. If they buy safe, regulated assets, they go bankrupt slowly. If they chase volatile tech stocks, they risk losing it all in a crash. They are trapped in a low-yield desert, desperate for an oasis. This was the golden age for shadow banking. The private credit funds appeared on the horizon like a mirage, offering a magical solution. They promised equity-like returns with bond-like safety. The trillions of dollars held by institutional investors were about to be funneled directly into the unregulated shadows, setting the stage for an unprecedented boom. The pension manager picks up the phone and calls a managing director at a mega-cap alternative asset management firm. "I am dying out here," the pension manager admits. "I cannot put my retirees' money into 2% government bonds. I need yield, and I need it now." The managing director on the other end of the line smiles, looking out over Central Park. "I have exactly what you need," he says. "We are raising a $20 billion direct lending fund. We bypass the banks completely. We lend directly to mid-market software companies and dental conglomerates. We secure the loans against their assets, and we extract a 9% yield. You give us your capital, we lock it up for 7 years, and we deliver the returns you need." The pension manager exhales. "Where do I sign?" This hypothetical exchange played out thousands of times across the globe. Pension funds, sovereign wealth funds, and insurance companies became the ultimate providers of capital for the shadow banking system, blindly pouring $3 trillion into a completely opaque market. To visualize how massive this pipeline became, imagine a colossal water treatment plant. At the very top, you have the raw reservoir of global retail and institutional wealth. In the past, this water flowed through the heavily monitored filtration system of traditional banks. Now, a massive bypass pipe has been installed. The Alternative Credit Council reported that by 2024, the global private credit market had surpassed $3 trillion in assets under management. The sheer concentration is staggering. Picture a funnel where 80% of all new capital is controlled by a tiny handful of colossal megafunds. These are the new titans of Wall Street. They are writing billion-dollar checks for leveraged buyouts, extending asset-backed credit against receivables, and financing vast real estate empires. They have essentially recreated the entire loan book of JP Morgan or Citigroup, but they have housed it inside private, closed-end vehicles. They have engineered a system that captures the immense profits of corporate lending while perfectly insulating themselves from the daily scrutiny of public market regulations. The genius of this golden age was the illusion of unshakable stability. Because these private credit funds are mostly closed-ended, they do not offer daily liquidity. Investors cannot simply log into an app and sell their shares if they get scared. Furthermore, the loans they make are not publicly traded on an open exchange. There is no daily ticker flashing red. The funds use a practice known as mark-to-model rather than mark-to-market. They decide what the loans are worth based on their own internal mathematics. If a public bond drops 20% in a panic, the private credit loan right next to it might miraculously report a 0% drop, simply because the fund manager says so. It looks like a perfectly smooth, upward-sloping line of uninterrupted profit. But a smooth line does not mean the risk has disappeared. It just means the risk has been hidden behind a curtain. The golden age was built on the premise that interest rates would stay low forever. But inflation was about to awaken, and the cracks in the shadow system were about to split wide open. Austin, Texas, late 2023. The air conditioning hums relentlessly inside the glass-walled office of a mid-market tech firm. The chief financial officer is staring at a spreadsheet that is bleeding cash. The zero interest rate world is dead. The Federal Reserve has aggressively hiked rates to combat inflation. The paradox of the shadow banking boom is suddenly revealing its lethal flaw. The vast majority of private credit loans were issued with floating interest rates. When rates were at zero, the debt was easily manageable. But now, the cost of borrowing has doubled in a matter of months. The tech firm is suffocating under the weight of its own capital structure. Imagine a ship loaded with cargo. At sea level, it sails perfectly. But as the tide of interest rates rises, the cargo gets exponentially heavier, pulling the ship violently below the waterline. This is not an isolated incident. Across the globe, thousands of heavily indebted companies backed by private equity are quietly running out of cash, triggering a silent alarm inside the heavily fortified walls of the shadow banking system. The sweating CFO dials the number of his private credit lender in New York. "We have a massive problem," the CFO says, his voice tight. "Our debt service costs just jumped by $4 million a month. Our revenues are flat. We literally cannot make the cash interest payment this quarter." The credit manager does not panic. Shadow banks have a trick up their sleeve. "Do not worry about the cash," the manager replies smoothly. "We will just amend the agreement. We will use a payment-in-kind toggle. You don't pay us cash today. We just take the interest you owe us, and we add it to your total principal loan balance. You owe us more tomorrow, but you survive today." The CFO slumps in his chair. "So we are just borrowing more money to pay the interest on the money we already borrowed?" "Exactly," the manager says. "Welcome to private credit." This is the dialogue of a system kicking a massive ticking time bomb down the road, disguising corporate defaults as clever financial restructuring. This payment-in-kind mechanism acts as a cloaking device for systemic distress. Imagine a pressure cooker with no gauge. The pressure inside is building exponentially, but from the outside, the metal shell looks perfectly calm. The Alternative Investment Management Association reported that many of these funds also use leverage at the fund level, averaging around 32% of their net assets. So, you have a heavily leveraged company borrowing from a heavily leveraged private credit fund, which is managing money for a pension fund that desperately needs cash returns. Picture a Jenga tower where the wooden blocks are made of debt. The shadow bank is pulling blocks from the bottom of the tower to stack them on the very top, while simultaneously standing on a platform that is also made of debt. If the underlying corporate earnings do not magically rebound, the entire structure will mathematically collapse. The shadow banks are playing a trillion-dollar game of chicken with global interest rates, betting that they can restructure their way out of a mathematical impossibility. The sheer scale of this opacity is terrifying regulators. The Financial Stability Board's latest assessment revealed a horrifying number. The broader, non-bank financial sector now holds over $256 trillion in global financial assets. They control 51% of the entire global financial system. More than half of the world's money is operating in the shadows. The narrower subset of bank-like entities with serious stability risks totals $76 trillion. Regulators are flying completely blind. They are apprehensive about the extreme opacity and the potential risks posed to the wider financial system. If a traditional bank gets into trouble, the government has X-ray vision into its books. If a mega fund managing hundreds of billions in private credit starts rotting from the inside, nobody outside the firm will know until the gates are slammed shut. The cracks in the foundation are being frantically papered over with restructuring tricks. But the ultimate stress test is approaching, and the system is entirely stripped of the one thing that saves banks in a panic. The hypothetical near future. London's financial district is battered by a relentless, icy rain. The stock market has been plunging for 3 consecutive weeks following a severe macroeconomic shock. Inside the fortress-like headquarters of a private credit megafund, the atmosphere is toxic with panic. The paradox of the closed-loop system is violently unraveling. The underlying corporate borrowers have finally exhausted all their payment-in-kind tricks. They are defaulting in waves. At the same time, the institutional investors, the pension funds, and the sovereign wealth entities are experiencing severe liquidity drains in other parts of their portfolios. They need cash immediately to survive. Imagine a crowded theatre where someone yells, "Fire!" In a regulated banking system, the exits are tightly managed by government firefighters. In the shadow banking system, the owner of the theatre simply padlocks the doors from the outside and walks away. The great private credit machine, designed to capture yield in a perfect macroeconomic environment, is about to face the ultimate, merciless stress test of an illiquidity spiral. The chief investment officer of the Chicago Pension Fund frantically calls the managing director of the megafund. "The public markets are a bloodbath," the pension manager screams into the phone. "I need to redeem $500 million from your direct lending fund right now to cover my margin calls and pay my retirees." The managing director's voice is remarkably cold. "You cannot have your money," he replies. "What do you mean I cannot have it?" the pension manager demands. "Read page 412 of your prospectus," the director says flatly. "The underlying loans are illiquid. Our borrowers are defaulting. We have officially activated the gate. Redemptions are suspended indefinitely. Your money is locked inside the fund until further notice." The line goes dead. This is the nightmare dialogue of a shadow banking freeze. When the panic hits, the funds protect themselves by financially trapping their investors. The promised high yields instantly vanish, replaced by the terrifying realization that the institutional safety net was an illusion. To understand why a shadow bank freeze is so catastrophic, you have to look at the ultimate mechanism of survival in finance: the central bank backstop. Picture a commercial bank as a massive water tower. If everyone in town turns on their taps at once, the tower runs dry. But the bank has a secret underground pipe connected to an infinite ocean of cash, called the Federal Reserve's discount window. The government will flood the bank with money to prevent a panic. Shadow banks have no underground pipe. The International Monetary Fund explicitly emphasizes that these entities do not have formal access to central bank liquidity or public sector credit guarantees. When a private credit fund runs out of cash, there is no bailout. There is no magical rescue. They are entirely cut off from the lender of last resort. The liquidity transformation they performed, taking flexible investor money and locking it into 7-year corporate loans, becomes a fatal trap. The shadow banking system operates perfectly until the exact moment it needs a shadow central bank. Without a central bank rescue, the contagion spreads in complete darkness. It does not look like the spectacular, televised collapse of Lehman Brothers in 2008. There are no dramatic photos of bankers carrying cardboard boxes out of skyscrapers. Instead, it is a silent, creeping paralysis that chokes the real economy. As the megafunds freeze their capital, mid-market companies lose their lifelines. The dental conglomerates in Florida, the logistics hubs in Ohio, the software developers in California, they suddenly find themselves unable to roll over their debt. Covenant breaches trigger aggressive takeovers. The private credit funds ruthlessly seize the assets, liquidating companies to recover pennies on the dollar. Corporate payrolls begin to bounce. Mass layoffs cascade through the middle class. The pension funds, starved of their expected returns, are forced to slash retiree benefits. The financial time bomb detonates not on Wall Street, but on Main Street, transmitting the shockwaves of an unregulated credit bust directly into the bank accounts of everyday citizens. Today, the austere, heavily guarded headquarters of the Financial Stability Board in Basel, Switzerland. Inside a sterile conference room, the world's top financial regulators are staring grimly at a massive digital map of global credit. The paradox of their own creation is staring back at them. Following the 2008 crisis, they surgically removed the systemic risk from the traditional banking sector. They made the commercial banks the safest institutions on Earth. But in doing so, they inadvertently engineered a monster that is now twice as large and infinitely harder to kill. Imagine a doctor successfully curing a patient's localized infection by flooding the body with experimental drugs, only to realize the drugs have caused a massive, undetectable tumor to grow around the heart. The regulators are quietly panicking. They are now urgently planning dedicated stress tests for the private equity and private credit sectors. They know a shock is coming, and they know they are completely unequipped to handle a crisis in a parallel universe that controls 51% of global financial assets. Two senior regulators stand by the coffee machine, speaking in hushed tones. "The numbers from the Alternative Credit Council are terrifying," the first regulator whispers. "The global private credit market has breached $3.5 trillion. They deployed nearly $600 billion in a single year." The second regulator shakes his head. "It is the concentration that terrifies me. 80% of that capital is held by a few colossal asset managers. If just one of those megafunds miscalculates their fund-level leverage, the entire private debt market seizes up." The first regulator sighs. "And because they are not banks, we have absolutely no legal mechanism to bail them out before the contagion hits the pension funds." This dialogue represents the current, terrifying reality of global finance. The watchdogs are fully aware that the dog has slipped its leash and grown into a wolf. They are watching a slow-motion train wreck, armed with nothing but white papers and strongly worded warnings about opacity and regulatory arbitrage. This brings us to the ultimate mechanism of the shadow banking paradox. The financial system is governed by the law of conservation of risk. You cannot destroy risk. You can only move it. When regulators mandated that traditional banks hold more capital, limit leverage, and de-risk their trading desks, the risk simply migrated into the non-bank world. Picture a giant balloon. If you squeeze the middle as hard as you can, the air does not disappear. The ends of the balloon just violently expand until the rubber snaps. We squeezed the commercial banks, and the shadow banking system violently expanded to $76 trillion of bank-like entities. The private credit boom is not a brilliant innovation of modern finance. It is simply the oldest trick in the book, making highly leveraged, high-yield loans and hiding the volatility behind accounting tricks and legal structures. We have built a two-tiered financial reality. One is heavily guarded and incredibly safe. The other is a hyper-leveraged casino operating completely in the dark, holding the credit lines of the global economy hostage. The $63 trillion shadow is the defining economic threat of our generation. The private credit megafunds have become systemically important, but they are untested in a severe, prolonged depression. When the underlying corporate borrowers buckle under the weight of higher rates, and the payment-in-kind tricks run out of mathematical runway, the resulting wave of defaults will not be contained to Wall Street. It will instantly vaporize the returns of pension funds, insurers, and sovereign wealth entities. It will freeze the payrolls of the mid-market economy. The time bomb is hiding in plain sight, entirely legal, and growing at twice the rate of traditional lenders. The next crash will not be televised as a run on a bank. It will be a silent, devastating run on the shadows. If you want to survive the brutal realities of this newly engineered system, You must stop looking at the regulated light and start understanding the dark. Subscribe to Capital Curriculum and join the few who can actually see the bomb before it detonates.